We are witnessing the end of McDonald's as we know it in the United States. The prices of their meals have increased so much that people can no longer afford to eat there like they used to.
For example, the price of a Big Mac, one of the most famous burgers, has increased very significantly.
It used to cost $11.79,
But now it's gone up so much that people can't afford it.
McDonald's CEO has said that people earning less than $45,000 a year have stopped going, and it's not just in specific cities but throughout the United States. The price of a Big Mac has gone up 280% in the last 2 decades.
In this video, we're going to talk about what happened to McDonald's, what their strategies are, and what happened to the prices that we used to pay for their food, why they're no longer existent. So watch until the end. But before we get there, we need to talk about their story.
Many of us remember when McDonald's prices were much lower. In the 1990s, a Big Mac cost less than $3. There were even McDonald's ads from the mid-1990s where you could get it for less. Back in the mid-2000s, McDonald's had a lot of stuff for just $1, but that too has now disappeared. This increase in fast food prices is not only affecting McDonald's, but is a problem throughout the fast food industry. And this is going to have a big impact on the US economy in 2024 and beyond. The Wall Street Journal reported that 30 years ago, food did not consume so much of people's income. Consumers now spend more than 11% of their disposable income on food, the highest level in 3 decades. And the cost of dining out has especially increased.
Other chains like Denny's and Wendy's are reporting to their shareholders that customer numbers are down compared to last year's.
So, folks, this is a problem throughout the fast food industry. The price you pay for food in restaurants has increased because the costs of the things used to prepare that food, such as meat for hamburgers or potatoes for fries, have also increased. Also, there is an increase in the cost of labor, which is the money paid to the people who work in the restaurants. The cost of the cows used to make hamburgers at McDonald's has doubled since the pandemic began. At the same time, many US states are raising the minimum wage paid to workers. For example, California now has to pay fast food workers at least $20 per hour. But despite all these problems, McDonald's stock price continues to rise. Right now, one share of McDonald's stock costs about $295, which is 3 times what it cost 9 years ago. If you look at McDonald's stock price, it has been changing over the past 2 years, and you'll see that it has always gone up. So you may be wondering if there has been a disaster as bad as the pandemic where people couldn't leave the house, the fast food industry is in decline, and fewer people are going to McDonald's. In fact, the number of people going to their restaurants in the US is down 13% compared to last year. How is it possible that McDonald's is still doing as well? Well, the answer to this has a lot to do with the fact that McDonald's is not just a fast food company.
In reality, McDonald's is a real estate company. Yes, a real estate company.
The fast food giant had humble beginnings. The McDonald's brothers, sons of Irish immigrants, first opened a hot dog stand in 1937 in Pasadena before venturing out to open their first restaurant. By 1953, they had successfully used an assembly line to prepare hamburgers. They had already started franchising the system, but not the atmosphere or the name of their restaurant. Meanwhile, a debating machine salesman named Ray Kroc had caught on to the brothers' restaurant concept after selling them 8 of his debating machines. It was then that Ray could see the enormous potential and quickly became associated with the McDonald's brothers, working as a franchise agent. After 6 years of working with McDonald's and discovering that his ambition was no match for theirs, he decided to buy them out and became the owner of McDonald's Corporation in 1961. Franchising is a model by which fast food chains can expand quickly and efficiently using money from small investors. Ray Kroc perfected new franchising techniques, increasing the size of the corporation while maintaining strict control of its products. It was around this time that CFO Son Bond came up with McDonald's real estate strategy, which the company continues to use today. Instead of making money by selling supplies to franchisees or demanding huge royalties, McDonald's Corporation became the owner of its franchises. It was a brilliant strategy, so brilliant that it's how they continue to perform today. Being able to collect rent helps protect them from the ups and downs of the burger business. After all, you have to pay rent. In addition to these regular revenues, the corporation would keep a percentage of each store's gross sales. It is something we should all understand because it helps us understand how the economy works and how large companies in the United States continue to advance while small businesses and consumers continue to suffer. McDonald's is a perfect example of this. There are about 40,000 restaurants worldwide, but 93% or 38,000 are owned by franchisees. These franchisees are individuals or companies that pay McDonald's to use its brand and sell its products. McDonald's owns only 2,000 of its restaurants. McDonald's, despite being a fast food restaurant chain, does not actually control the menu prices of each of its restaurants. This is because most McDonald's restaurants are franchises. In addition, McDonald's doesn't really care how much the ingredients cost to make the food or how much the workers are paid at each restaurant. The way McDonald's makes money is independent of these costs. Instead, McDonald's makes money by charging franchise fees and rent to franchise owners. McDonald's looks for a location that has a lot of traffic, such as a shopping district or a busy part of town. It then buys the land in that location at a fixed price. Once McDonald's owns the land, it builds a restaurant there. This restaurant will be a McDonald's with all that implies: the menu, uniforms, signage, etc. When the restaurant is ready, McDonald's looks for someone who wants to manage it. Thus, this person becomes the franchisee, and they enter into a 20-year franchise agreement. The franchisee then has to pay McDonald's various fees. These include a 4% royalty fee for the right to use the McDonald's brand, a 4% marketing fee to help promote the restaurant, and a 12% R fee, an extra fee that the franchisee has to pay. In addition, the franchisee must pay McDonald's rent for the lawn on which the restaurant is located.
Once the franchisee has paid all these fees, he or she can start managing the restaurant.
This includes hiring the workers, buying the ingredients for the food, keeping the restaurant clean and safe, and, of course, starting to sell. The land that McDonald's purchases for its restaurants is usually located in busy areas of the city, such as central business districts. These locations are very desirable because there is a lot of traffic, which means that there are many people who could enter the restaurant. And while food prices may rise with inflation, the cost of owning property remains the same.
In total, McDonald's has amassed a real estate empire of around $40 billion.
McDonald's original chief financial officer, Harry Sonbon, said in the 1960s that McDonald's is technically not in the food business, but in the real estate business. The only reason we sell 15-cent burgers is because the customers who buy them are the biggest producers of wealth. With them, franchisees pay the rent of our land. In other words, the only reason they sell hamburgers is because they are the most profitable way for their tenants, the franchisees, to pay them rent. This business model has worked very well over the past 50 years for both McDonald's and its franchisees. The costs at these fast food restaurants were quite low. Demand was good and there was a lot of growth. But now we're entering an environment where people can no longer afford to eat at McDonald's. As we told you earlier, McDonald's CEO Chris Kempczinski recently said,
They're experiencing pressure in the lower income consumer segment, especially those earning less than $45,000.
He believes they are eating at home as that has become more affordable. So, who really is the primary demand segment for McDonald's and other fast food restaurants, if not low-income households and consumers? The value proposition for fast food restaurants for so long was that you could go there and get a meal for $1.05 or $1.06 and feel full. Now you have to pay from $12 to $15. That means McDonald's and its franchise owners will increasingly have to rely on middle and upper income audiences to sustain their business.
But do you think that people would prefer going to a fast food restaurant when they can go to Chipotle or Shake Shack and get higher quality food for a similar price?
To give you an idea of how prices have changed over time, take a look at this chart. It shows the price of a Big Mac hamburger for the last 50 years. In 1970, a Big Mac burger cost half a dollar. It then rose to $2.30 and stayed there.
Even in 2005, it cost $2.50, but now it went up to around $5.60.
In total, that means the price of a Big Mac has risen 249% over the past 40 years, which has significantly outpaced wage growth. We could be seeing the beginning of the end of the golden age of fast food in the United States. With food and labor costs on the rise, more and more McDonald's franchise owners may begin to struggle. In the next 5 to 10 years, we could see many owners deciding to sell their restaurants, and if there are no buyers to replace them, this could reduce McDonald's value and damage the brand in the long term. However, there is another option. These fast food restaurants may stop raising their prices and may even reduce them. But unfortunately, what we are likely to see is a reduction in workers. This is something that has been happening over the last 5 to 10 years with an increase in automation. It happens more and more often that when you go to a fast food restaurant, you see that there are fewer workers. In fact, last year in Fort Worth, Texas, McDonald's launched its first fully automated restaurant with no human contact. Now, McDonald's is taking the initiative to make its customers' lives easier and faster by introducing technology-driven solutions. We don't know if you agree or disagree that automation is already taking away not hundreds, but thousands of jobs. However, this is a trend we are likely to see more of in the future. As more states across the United States dramatically increase the minimum wage, there will be an incentive for McDonald's and fast food franchise owners to have fewer and fewer employees. Remember that the typical McDonald's franchise owner in the US could be earning $3.2 million in revenue,
but only averages $290,000 in earnings.
By far, its largest expense is labor costs. It is these labor costs, as well as the cost of food, that have increased significantly in recent years, which has driven them to increase their prices, leading to a large drop in customer traffic. The quickest way to solve this problem, if you are the franchise owner, is to reduce expenses. And of course, we know that McDonald's is not going to cut the 20% it is asking franchisees to cut. So these owners will be looking to cut labor. Replacing workers with machines that don't get sick, ask for vacation, or spend time training them would make them more profitable and reduce the need to raise prices so much in the future. One state where we see this happening very quickly right now is California.
The state of California is about to pass a bill that states that a fast food worker should get paid at least $20 an hour.
That's $4 more than the normal minimum wage of $16 per hour. We're not sure why they thought they needed to do this, but they did. Companies are not very happy with this new law. In fact, Pizza Hut is so upset that it has already reported that it will lay off thousands of delivery drivers in California by 2024. This is a direct response to this new law. ABC News in California spoke with the head of Chibahar, a sandwich store. He said this new law is forcing them to raise their menu prices and look for ways to have fewer workers so they can continue to make money. So yes, they are limiting the number of workers they have. The fast food industry is going into a cycle of trouble. If this happens, the entire current economy in the United States will be in trouble. The U.S. Small Business Optimism Index is near its lowest level in decades. Small business profits have also fallen to their lowest level in decades, almost matching how bad they were just before the 2008 crisis. In the last 3 months, 30% more small businesses have reported that their profits have decreased rather than increased. And unfortunately, in the US, it is the small businesses and consumers who suffer first from these problems. In the meantime, large corporations like McDonald's can continue to make money at times like this. That's one of the reasons we see the stock market doing so well, while most people in the US are in a critical situation. We hope that restaurant and fast food owners can find a way to stop raising prices so much, but with the government's large increase in the minimum wage and the prices of basic commodities such as beef remaining so high, it will be difficult for them to do this. What is likely to happen is that, as a result, there will be bankruptcies and massive layoffs of small businesses at some point. However, we will have to monitor the situation over the next few months and over the next year. So, tell us, how is your local McDonald's doing?
This is the end of the video. I hope you liked it, and if you did so, do me a favor and subscribe to the channel for more content like this and hit the like button for the YouTube algorithm. It really helps the channel grow. I hope to see you next time. Bye.